Hey everybody, it's Elliott with Touchstone Financial Education once again, and today we're going to talk about how to choose investments, and this video is designed specifically for you beginners. Now, in the last video we discussed how to choose a platform because I'm getting started investing. I want to learn everything that I can. We've opened that account at Vanguard, Fidelity, Schwab, E-Trade, wherever it may be. We've connected our bank account. Now it's time to go ahead and start looking at how to choose investments. But let me get a little business out of the way. Here at TFE, we do not sell any financial products. We're also not a fly-by-night organization that's trying to make you rich overnight. This is about prudent, long-term, disciplined investing and providing information along those lines. Basically, no selling, just education. If you've got any questions about anything in the financial world, shoot us an email. You can go to touchstonefinancialeducation.com. Send us that email. We'll respond within 24 hours. And by the way, these videos really are an accumulation of questions I've had over the years from clients as well as viewers and listeners. So please reach out. We won't inundate you with a lot of information. We do send out a quarterly email, and that's it. So now on to the program, choosing investments. Again, for you beginners now, you've opened your account, you've connected your bank account, and what do we do next? Well, when we open that account, if you remember, you answered some questions about how old you are, what type of investing have you done in the past, how far away from retirement are you, how conservative, moderate, or aggressive do you think you are? These questions are designed to help narrow down the types of investments that your platform will present to you as viable options. It's called a risk profile questionnaire, and it helps you to develop that risk profile so that you're not investing in things that you shouldn't be in. So for example, if you're a couple of years away from retirement, you should not be that aggressive, and hopefully the options presented to you are not aggressive, they're more moderate to conservative. Conversely, if you are younger, you're just out of school, starting your first job, signed up for the 401k for the first time, well, the sky's the limit and you should be aggressive, and the investments that you see presented to you from your platform should reflect that. You should have a lot of funds that got technology in it. You should see things that have emerging market options. An emerging market is foreign investment in second and third world countries. By the way, China is included in that. So we've got China, the Middle East, parts of Africa, parts of the world that are aggressively growing. It's aggressive, but the younger you are, the more likely you will benefit from having those types of investments. So we've logged into our platform. We see these options. What do we do? Well, the first thing we're going to do is start with a moderate position. Let's start with the S&P 500. And in all my videos, I stress this highly. Whether you're close to retirement or very young, start in the middle. Start with moderate investments. All right. I do like the S&P 500. There are S&P 500 funds out there like SPY, VOO, FBLAX, which is a Fidelity fund. They're all pretty much the same. And when we start in the middle, then we can go from moderate positions to aggressive or moderate to conservative, depending upon where we are, or more importantly, how we answered those risk profile questionnaire questions. So now we're in the middle. We're going to take a look at a fund in the middle. And what are we going to do? We're going to look first and foremost at performance, because we are here to create wealth. We are here to grow money long term, taking advantage of that compound interest year after year after year. So in your platform, there should be a way to determine the performance of the investments that you're looking at. And one of the most popular ways to look at funds, not stocks, but funds, is a Morningstar page or Zacks. Both evaluate funds, and they've been doing it for years. They're very good at it. One of the things I'd like to say is I like Morningstar because it has a 5-star rating basis. The higher the number of stars, the better the fund has performed. And not just how it's performed individually, because it does not operate in a vacuum, but how it's performed relative to other funds in its category. So you'll see on a Morningstar page, let's say it's got 5 stars and it's up 10% year to date. It'll also show you how it has performed relative to other funds in its category. So if there's 800 funds in the category and it's coming in at number 27 and it's at 11%, hey, that's probably a great fund to choose or to put on your watch list. And you go down through the funds presented to you by the platform, and you can do that with each one. Now, it sounds like this is a lot of work. It is if you're a beginner, but guess what? When I say a lot of work, a lot of times this type of analysis can be done in under a half an hour. So you don't have to take a lot of time evaluating the performance of moderate growth funds, in particular S&P 500 funds, or put it another way, passively managed funds. And all that fancy phrase means is that it's a fund that invests specifically in an index, nothing else. So whatever is on the S&P 500, that's what you're going to get in your fund. Whatever's in the NASDAQ 100, that's exactly what you're going to get. And once we've evaluated the fund for its performance, next step is to look at what is the cost of the fund as an investor. It's called an expense ratio, and this is very important. How much does it cost to have your money in that fund year after year? Well, if we go back to passively managed or index funds for a second, you'll find that they are some of the least expensive funds out there. They will have expense ratios of 0.03 to 0.05%. Fidelity has a few that are a little bit lower than that, but at the end of the day, these are very inexpensive funds to use to grow your wealth. For example, if you see an expense ratio of 0.03%, that means that the fund will cost you $30 a year for every 10 grand invested. That's almost free in the investment universe. You're not paying a whole lot of money. The next category of funds you might find on your list proposed by your platform, they are actively managed funds. And what that means is there's a team of money managers picking stocks, picking bonds on your behalf, and their goal is to outperform the market. And remember what I said about emerging market and international funds? A lot of them are actively managed, so they're going to have an expense ratio that is much higher than an index fund or a passively managed fund. So you'll see funds from 0.3% all the way up to almost a full percentage point on the expense ratio. Now, does that mean because it's so expensive relative to index funds, we shouldn't do it? Not at all. That's where we go back to our performance. Let me give you an example. Let's say the markets are up 10% year to date, and you found a fund that is heavily invested in technology in India, for example. Well, India's done pretty well. China's on its way back up. We might look there as well. But let's say those funds from India and China have a year-to-date performance of somewhere in the neighborhood of 15%. Well, you are paying for that performance with the higher expense ratio. Again, doesn't mean it's bad because it's more expensive, because look at the performance you would have achieved. They're more aggressive, of course. Remember, we start in the middle and we move up to be more aggressive or down to be more conservative. But the bottom line is a higher expense ratio does not necessarily make it a bad investment. And I want to stress that because there is a lot of information out there that says stick to low-cost investments only. Yes, 100%, middle-of-the-road domestic growth, meaning companies in the United States, but don't forget those actively managed funds that at time to time, they do outperform the markets. They do have a place in your portfolio, perhaps not as large as the passively managed or index funds, but they do have a place to boost that performance. And as you grow as an investor, naturally you will be attracted usually to more aggressive growth. Doesn't matter your age, you just get comfortable with taking more risk. So keep those actively managed funds in mind as well. So remember, going back to the last podcast video, we chose our platform. So today we're talking about how to choose investments. We're going to look at that performance. We're going to use things like Morningstar and Zacks, which has a similar approach. They don't use stars, but they do use categories. I prefer Morningstar, as you can probably tell, because it's easier to look at. It doesn't take as long to do the analysis. It's got the 5-star rating. It'll show you the expense ratio. It'll also show you how the fund performed relative to other funds in its category. And then we take it from there and we determine how much money we want to put to work. And I got to say this, because we're talking to beginners, because we are using a long-term buy and hold strategy, this isn't an investment or a series of investment choices where you're going to put money in and take it out quickly. We're not trading stocks. We're in it for the long haul. This is the Warren Buffett, Berkshire Hathaway style of investing. You won't get rich overnight, but you will grow your wealth prudently in a disciplined manner, and hopefully that will help you achieve your goals. And that's what I had to say today, ladies and gentlemen. Next video, we're going to get into a little bit more detail on how to evaluate the funds that you invested in and start talking about how to watch the markets a little bit every week. Doesn't take that much time. If you've got 15 minutes a week, you can become a moderate to sophisticated investor at no time. If you have any questions, like I said earlier, please reach out to us at touchstonefinancialeducation.com. Send us an email. We will respond within 24 hours. If you're interested in the classes, the same, go to the website. Or maybe you're in a situation where you've accumulated some resources and it's a little bit overwhelming and you'd like to talk to somebody one-on-one who's not going to sell you a financial product. Give us a shout. touchstonefinancialeducation.com. We will help you out. Again, respond within 24 hours. Thanks for watching. Next time, more analysis on these investments. Take care. Please like, follow, share, and subscribe. We really appreciate it. And of course, the reach out as well. Thanks for listening, everybody. Talk to you soon.